Americans are getting rejected for auto loans at the fastest rate ever recorded, and that could mean that lower prices for new cars are just around the corner. But don't start celebrating just yet. When you find out why, you'll realize this is not a sign of better things to come. What's up, guys? I'm Nobody Special, and this one hit the tape just today in Kelley Blue Book. According to the Federal Reserve, a record number of applicants are getting rejected for car loans. Lenders are rejecting more applicants for car loans than ever, according to a new study from the New York branch of the Federal Reserve. More than 14% of applicants were rejected over the 12 months ending in June, and that is a record high. The number comes from the Fed's survey of Consumer Expectations Credit Access, published every 4 months. And the last time the Fed published the data, in February, it was 9.1% of applicants had been turned down. So just since February, we've gone from 9.1% of applicants getting rejected for a car loan to 14% of applicants getting rejected. That's nearly a 54% increase in the number of rejections. But it's not just car loans. Americans were rejected for all types of credit 21.8% of the time, the report says. The reported probability that a loan application will be rejected increased sharply for all loan types, the Fed says. It rose to 30.7% for auto loans, another record high. So what's going on here, folks, is that banks are really tightening their lending standards. After the collapse of Silicon Valley Bank in March, and then later Signature Bank and Silvergate Bank and Credit Suisse, finally First Republic Bank, the banks have all started to play defense. They're being very careful who they lend to. They have very little tolerance for risky applicants, which means more rejections are coming. And the most vulnerable segment of the market to that is auto loans. And it's not too hard to figure out why, especially when you look at this one from back on July 2nd in CNBC. With just 8% of new vehicles costing under $30,000, it's the least affordable car market in modern history, experts say. So this is the culmination of a lot of factors here. During the pandemic, we had the chip shortage, and that caused a lack of production of new cars, so it restricted supply. At the same time, you had the Federal Reserve was helicoptering money all over the world with their quantitative easing, so that made buyers flush with cash, able to bid up the price of the few cars that were left on the market. Then 2022 hits, and the Federal Reserve decides, okay, now it's time to fight the inflation that we caused, and so they decided to raise interest rates at a pace we haven't seen in a very long time. So that means those payments have gone up, not just because the price is higher, but because the interest rate is higher. Oh, and at the same time, those interest rate hikes have caused a banking crisis, so now the banks are even less likely to lend to people. So this means it is just about the worst time in history to be in the market to buy a car. But the optimistic way to look at that is there has never been a better time to wait to buy a new car. And now that's already starting to show in the used car market. This is the Manheim Used Vehicle Value Index. This tracks the wholesale prices for used cars. This is what your car dealers are paying for big lots of used cars. And you can see all the way over there, that price went vertical in 2021 through 2022, but it has started to fall, and it's falling fast. But we see something very different when we look at the price of new cars. This is the Consumer Price Index for new vehicles. And you can see in this chart, right around the spring of 2021, when the chip shortage hit, the price of a new car started to go higher, sharply higher. It continued higher all through last year. And even though the chart is starting to level off now, you can see the prices for new cars are still rising, even though they're rising much slower. But so far, consumers have been willing to pay these higher prices. This is looking at new car sales in the US going all the way back to the 2010s. Now you can see here we had a big drop off when the pandemic hit. That quickly recovered, especially as all the helicopter money got pumped out into the economy. So new car sales recovered. But then in early 2021, we had the chip shortage hit. That was a big shock to this system. But sales have kind of bounced around but steadily recovered ever since the peak of the chip shortage. Now they're still below their pre-pandemic levels, but new car sales, the volume of sales, is still on the rise. But it's not until you look at new car production that you start to understand why these prices have gone vertical and why they remain stubbornly high. Look at the number of cars produced in the United States. Now you can see here through the 2010s, car production in the US was pretty consistent, but that number started to decline right around 2015, way before the pandemic, and it continued lower all the way through 2018 and 2019. Of course, then the pandemic hits, and that number drops off a cliff, it bounces right back, then the chip shortage hits, and that number goes down lower again. Now, new car production has still not recovered, nowhere near those pre-pandemic levels. So now you can start to understand why those new car prices have been stubbornly high, even though many buyers have been priced out of the market through these higher interest rates and these higher prices. There's still just not that many new cars hitting the market, and so the prices thus far have been very resilient. But that may be about to change. According to this article from all the way back in April, oversupply of cars to trigger a price war, according to UBS. A glut of cars on the market is to trigger a price war among manufacturers as demand fails to keep pace with supply, analysts have forecast. UBS has estimated that global car production will exceed sales by 6% this year, leaving an excess of 5 million vehicles that will require price cuts to shift. A brimming order book for most car makers means that prices are likely to remain high for the first half of the year, analysts at the bank said. After that, sluggish economic growth and higher living costs will squeeze potential buyers' ability to afford new cars, which is likely to hit prices as cars remain unsold. And boy, if that note wasn't right on the money, check this out. Just a couple of days ago, 2023 Ford F-150 Lightning base price drops by roughly $10,000. And it's not just Ford cutting prices. Tesla has been cutting prices too, and there may be more price cuts from Tesla coming. This is from just this morning on their earnings call. Tesla may keep cutting prices in turbulent times, Elon Musk says. And you can see it in some other, maybe not quite so obvious places, like in this chart here of platinum prices. You see what we got right here? This is a death cross in platinum futures. A death cross is when the 50-day moving average, shown here in blue, crosses below the 200-day moving average, shown here in red. That is a very bearish technical indicator for the price of platinum, and we just had that happen just 2 days ago. Well, consider that 40% of platinum demand is for use in catalytic converters for internal combustion engines. This is really a chart that's saying there's bad things coming in the market for new cars. Or more specifically, bad things in the market for new catalytic converters, which are attached to new cars. And let's not forget the borrowed elephant in the room. U.S. Supreme Court strikes down student loan forgiveness plan. 1 in 10 Americans has a $400 student loan payment coming back in October, and that comes at a time when the average car payment in America has ballooned to over $700. That means there's a lot of people who can just barely afford their car payment now who have an extra $400 a month coming back in a few months. That's going to further price out a lot of people from the car market. That means fewer buyers, less demand, prices heading lower. So long story short, guys, with banks tightening their lending standards, unwilling to lend to people, auto loan rejections at the highest rate ever. Combine that with stubbornly high prices, manufacturers who are producing too much for this market, student loan payments coming back, and that subtle death cross in platinum futures, there's a lot of reasons to suspect that there are hard times ahead for the auto market, which means new car prices will be heading lower. They're already starting to. We're seeing it in electric vehicles like Ford and Tesla. We're going to start to see that soon in internal combustion engine cars as well. So if you're in the market for a new car and you can afford to wait, there has never been a better time to exercise a little bit of restraint. This market will reward patience. New car prices are bound to head lower very soon. And until next time, live small and dream big.